one of the listed company in Singapore, they hedged wrongly on the oil price and lose a lot of money.
Oh my.
That kind of mistake can happen,
Yeah,
right? That is
yeah.
more on the oil side.
Yeah,
You don't mention name, you know.
It's okay. We get it. Yeah. You don't get it also okay. We're not going to say. When you meet us in person, maybe you do a live event.
Right.
Maybe we can tell you off screen. Yes.
So there are a lot of danger in the investment world. You have to know all these things. If you don't know all these things, those are the risks.
Okay, 很久没有碰面了. Okay, this is an English show. Okay, so it's been a while. It's been a while. Yeah, this is Kenny, regular on our show previously. But it's our new set. Right, this is our new set. You haven't been on the show yet.
Yeah, this is the new location because the previous one with the Financial Coconut was on the Mandarin channel.
Yeah.
Right, the
English your first time on the English channel?
No. I think the third time in the English channel.
Okay. Right. Great.
If you can remember the first two topics, how the investor can lose money, go and
Yes. Check it out. Yes. But today is our first time one-to-one.
Yes.
It's our first one-to-one. Okay, great. One-to-one is a privilege, man. Not easy.
Maybe not.
We had one earlier, but no video.
No video, correct.
That was long ago. But yes, for our listeners that somehow don't know you, can you just do a short introduction of who you are?
Okay, I'm Kenny Law. I am a licensed financial advisor. My specialization is in REIT investment in Singapore. So when you Google Singapore REIT, probably you can see me on the Google search, right?
Yeah, your SEO very optimized. You're up there. Everybody, and all the other boys are getting you on their show. SGX, everybody.
Yeah, SGX, Money FM. Then now the CRs, they are getting me on the board and those things. Anyway, by the way, I don't pay for it.
Yeah. Basically, it's all earned media. He worked very hard for it, right? So it is what it is. But of course, that means people appreciate your views, right? On like what's happening in the market. And I think this year or maybe even last year, REIT market hasn't been like that amazing lah, right? So it's been quite bad, these 2 years. And I wanted to get you on the show to kind of go through what is happening, how should investor do this thing, how are they reacting, and some of the new trends of like the REITs, what are they doing, right? So maybe you can just kind of walk us through like what do you see in the market today?
Yeah, actually for the past 2 years, the Singapore REIT sector really is quite badly performed.
Balik kampung, very bad.
Very bad. And there are many investors, if they don't really have a faith in the REIT investing, they are thinking of giving up. Because I have a client, I have a student, I also have an investor ask me whether they should liquidate or not because they cannot tahan that kind of volatility, right? But if you look at it, we have to refocus back on why we need to invest in the REIT at the first place. REIT at the end of the day is a real estate investing. You just think of yourself that you are investing in a physical property, right? When you invest in a physical property, what is the main objective? You just want to get your property rented out, collect rental, and just wait for the rental to come in, right? Whether the price go up by 10%, 20%, or drop by 50%, you don't really bother as long as you can get your property tenanted. So in REIT space, it's exactly the same thing. After we invest in REIT itself, we need to wait for the REIT manager to deliver the dividend. You have to wait. You have to have a patience, right? But when the market drop by 50% or 80%, some of the REIT itself, then people start to panic.
Oh, there are REITs that just fell by 80%.
80%. But if you think of it, the property is still there. There's still the grade A property. In the CBD area, and there are no office supply surrounding. But the share price dropped by 80%. The price to book, basically dropped to 0.2. Which means that, in other words, a layman, the property value worth 1 million, but at the present moment, the market price, the indicative market price based on, because a REIT is traded on a stock exchange, it's only trading at 0.2, which means 200,000 worth of value. But if you look at it, it's still the same property. They are still tenanted in the CBD area. So does it really make sense to really trade it at 200,000? Right? So the whole REIT sector itself basically is driven by interest rate. Interest rate is the major culprit. I would say that after this 2-year analysis, they are the main contributor why the REIT sector is doing very badly. Because the interest rate actually affected a few fronts. right? It's not as simple as that. Our interest goes up, then after that, the REIT have to pay more interest costs, then the DPU drop. It's not as simple as that. So I would classify into the three so-called segment. The first one is a fundamental, right? When interest rate goes up, immediately the interest cost will be increasing. That will have the impact on your bottom line, which is DPU payout. I'm getting more and more technical.
No, it's great. You're on the right show to do technical. Yes. But DPU payout essentially is a dividend. Right. Yeah. Distribution per unit. Right. But in a REIT setting, they call it DPU lah. But
they call it DPU.
Yeah, it's just a different. Yeah, it's
that's
essentially
why
dividend.
Just for education basis, when you see all the number, all this kind of different DPU, DPSS, dividend, you'll be very confusing, and coupon will be very confusing. At the end of the day, it's a very simple thing. Whatever money you get back is something like dividend.
Yes,
it's just a dividend, DPU, distribution per unit for REIT. Right? So the bottom line will be impacted. When your dividend impacted, automatically their share price will drop, because there's always a ratio. The dividend yield is equals to DPU payout for the past 4 quarters divided by the current share price. Right? So market is always looking forward. When the DPO start to drop, they also anticipate the DPO start to drop in future. Then the share price has to adjust downward. That is more on the fundamental side. But the other thing, impact on the fundamental side, will be on the property valuation. If you look at the property valuation, the formula, the model, they're looking at all the future cash flow discounted to the present value and divided by the cap rate. Right? So when interest rate goes up, basically the risk in the market is going up. They are using the higher cap rate as a denominator, right? When the interest rate goes up, automatically your portfolio value will come down. It's all in the formula. But if you go back to fundamental, same property, CBD, and also collect rental, it's only the valuation. When the valuation drop, automatically your share price will drop, because there is always a ratio. But if you look longer term, eventually the interest rate has to be normalized. Over the long term, you just look at the historical data, right? At the present moment, we are in the unprecedented moment. The interest rate just go up too fast, too furious within the 2 years. Less than 2 years, 0.25% to 5.5%. That's the US interest rate. So you just imagine, if you are the physical property investor, you don't talk about REIT. If you are a property investor now,
it's very tautian. A lot of people's the mortgage is crazy. Yes,
right?
Yes.
Maybe you are getting a fixed salary of maybe $8,000. You're paying a mortgage loan maybe of $4,000. That is based on 2%, right? And after the refinance rate coming in, they from 2% go up to 4%. You just imagine how tight is the cash flow. And within 1 year, you have to do all the adjustments. You may not be able to service the debt. When you're not able to service a mortgage loan, then you may need to force sell a property. When everybody do it together, basically a share price will come down. This is exactly same as a REIT, because within 2 years itself, it go up so fast. The REIT itself, they are holding multiple property around the world. You have different forex currency coming in, and you also have different debt profile. And the debt for the REIT itself is not like our own mortgage. Our own mortgage, once you commit one lump sum, and after that you pay your interest and pay your principal over 15 years, 20 years. But for REIT, they don't pay down principal. Basically, they issue the debt maybe 5 years. Then this 5 years, you have to continue to pay all your interest. It's a coupon. After 5 years matured, they have to refinance.
Kick it down. They
refinance. Yeah. You just imagine, when the property value drop, your gearing ratio goes up, right? There is also a ratio when you do a refinance, right? Because we have a gearing limit there.
Can you expand a little bit gearing ratio?
Okay. Gearing ratio, the formula is total debt divided by total property value. Your debt more or less the same, because they don't pay down a principal. All right. Your total asset value you drop due to the valuation. So your gearing ratio you drop. Right, gearing ratio drop, and also when you borrow money from a creditor, borrow money from your bank itself, there are certain ratio you have to comply. Okay, so that will limit your ability to borrow more, or you have to reduce your debt. The problem is REIT has to pay out 90% income back to the shareholder. They do not have cash. So when they are not able to refinance that higher debt, they have to look for money from somewhere. They have to issue additional share to collect, to raise a fund from a shareholder.
Dilute themselves.
Right? So there are multiple fund on that area.
Okay. I just want to add to that, right? I think what Kenny was saying is actually the gearing ratio is going up. Going up, not going down, going up. So that's the first thing. But importantly, I think for a lot of you tuning in, if you're first time in understanding this REIT thing, right, there's actually a cap to how much gearing ratio you can go, right? It's within the structure of this REIT tool. Everybody has some consensus around this, right? Like, is it 40% or was it like 50%? Yeah. So you cannot go beyond that. So once you go beyond that, then you have to adjust, right? Yeah. Which is where either you sell more of the REIT, you dilute, the overall asset value, because of more REIT units out there. Yeah, so the per unit value come down, or you have to take on more debt, right? Or which is very hard because at this point in time, it's just crazy.
And because the interest rate is going up, after you mature, you have to refinance. The only way is refinance at the higher rate.
Okay.
That will hit your DPU again.
Okay.
Right.
Okay. Fair.
So interest rate definitely will increase the interest cost, and at the same time you devalue your property. Right. Depends on location. Right, Singapore property, Singapore sector not so much affected, but all the overseas REIT with overseas portfolio, they are all impacted because the risk level is higher. So, and also cap rate used in the overseas property is much higher. For example, for the Singapore commercial office, the cap rate is around 3.5%, around that range. But when you move to Australia, US, and also Europe, is between 4 to 6%. It's on the very high end.
Can you expand a little bit on what is a cap rate?
Cap rate basically is a capitalization rate, and in other words, is a discount rate, something like that in the property value. Is a valuation. They use it as a cap rate, but it's highly correlated to the interest rate.
Okay.
Yeah, if you do not know, just Google it.
Just Google it. It's not very complicated one. Okay, but I think underneath it, your genesis is that all these things are happening and it's causing the market to go in a frenzy. But this whole thing actually is just a financial...
It's a financial... Even though it's just a number.
Yeah.
Right? Now, as an investor, we have to look forward. All right? Now, it is what it is. The share price drop a lot. Your portfolio red color, it doesn't matter because at the end of the day, our focus is dividend. Right? 1 year down the road, 2 years down the road, and by the way, based on the CME group, the 30 days Fund future, and even a dot plot, the interest rate is expected to start to come down in Q3 2024. Right? So it's coming down. 2025 will be coming down. That is an outlook for next 2 years. When it start to come down, immediately your cap rate will drop. Right? And at the same time, your property value will go up, your gearing will come down, and the ratio will expand. Then you go back to normal again, right? So if you have a long-term horizon, 5 years, 10 years, 20 years, all this kind of market volatility, basically you even out and then sell without doing anything. You don't need to panic sell because some investor look at the share price drop by 50% or panic. But they always forget why they are investing in REIT at the first place and their investment horizon. If you have a 10 to 20 years, you don't really bother. And we need quite a long time to build out our REIT portfolio for our retirement as an income replacement, that kind of asset. I spent more than 10 years to build out my REIT portfolio. I still have not met my target yet. So every time there's a price weakness, is a good time to continue to accumulate because you don't have money at one time to accumulate everything. You probably every year you have some money that accumulate at different stages. And just back to basic, use a common sense when it comes to REIT investing. It's exactly a real estate investing. You want to look for the real estate which is selling at a huge discount and able to collect the rental consistently and able to rent out easily. Right? Just use this basic concept and you can see a lot of good durian among someone out there.
A lot of durian. But yeah, I think in the commercial property space, right, not REIT, commercial property space, there is this game, right, where you put in an X amount to kind of refurbish this place and then you engineer a higher property yield from it, like rental yield from it, and then immediately it will reflect in the commercial value price that you can sell out. Jump. Yeah, in the market, right? It is a game that a lot of real estate investors are doing, right? Like not the small guys, like the mid-sized guys. The big guys just do their own thing, right? But the mid-sized guys are going around. You see all this upgrading development, the shop house like this, that. Yeah, it's all about engineering a higher yield with that commercial property and then recycling and selling that property out. So they buy cheaper, upgrade, sell.
Yeah.
Right. It's part of the game. So yeah, that's
in
what
this
they
space,
do.
they call it AEI. Basically, it's upgrading. Because once you upgrade the building to the green building, now we are talking about ESG again, right? There is a premium when there is the valuation. And at the present moment, when I ask around, nobody give me exactly what's the number and what is the premium for the green building. But I get to know one retired valuer. He just give me one number, not official number, by the way, 7 to 8%. There's a premium. That means compared to those buildings who don't have a green certification, those things.
Oh, okay.
Right.
Okay.
So for us as a retail investor, we don't have that kind of capital to play this kind of game. But for REIT itself, at the present moment, they are focused a lot of activity on the AEI. Right, because when the business is so slow and when they do not have any liquidity, because high interest rate, they cannot go for very aggressive acquisition during this period. The only thing for them to grow the DPO, the top line, right, is through the AEI, Asset Enhancement Initiative.
Okay. Fair, interesting. That's a fair point because I think like now is a bad time. Interest rates are too high. It's very hard to go and expand, right? It's essentially that's the two growth engine of a REIT is either increasing your rental yield, right? That means which is the AEI part, increase your rental yield or get more REIT. Right, so you open the base or you optimize the property that you already own within the REIT structure, right?
When they want to raise fund at the present moment because the share price so low, and no investor want to subscribe to it. Basically, they cannot get any funding during this period. Get funding. Where are they going to get the money from doing the AEI? That's why some of the REIT, they introduced the DRP, Dividend Reinvestment Plan.
I got plan now.
Yeah, Dividend Reinvestment Plan. It's not new. Okay, basically, you can choose whether you want to receive a dividend in cash or receive a dividend in unit.
Yeah,
maybe 2 to 3% discount.
I know that. Yeah. Right. Okay. Yeah.
This is how they preserve a cash. And once you have cash, right, you are able to use the cash to really pay down some of that, some portion of it, or you just do upgrading.
But usually the more struggling REIT will do this, right? The bigger REIT is also doing it.
Bigger REIT doing this thing.
Wow. Okay, fair. I want to ask a little bit on the interest rate element, right? Because you say the interest rate, or you think like some of the bigger houses are saying the interest rates will come down, but I am also hearing another school of thought where interest rates will come down, but it's not going to be as down as what we are used to. Right, so it's going to broadly stay higher than the last decade or so. Like, what is your take on that? Because it's so important in your thesis, right? This interest rate thing, right? So I want to kind of get your take on like where will interest rate stand?
Nobody can predict the future.
Yeah,
of
course.
I would take those comments as a pinch of salt.
Okay.
Because before that, when we are under very low interest rate environment, nobody can think of interest rate can hit 5.5%. Nobody think of it before. At the present moment, based on what we can see, right, this US Federal Reserve, they just want to interest land at 2% or around that range, right? But you never know because there are so much uncertainty, geopolitical risk in the market at the present moment. And if you have another crisis come, you won't be surprised they'll push up the quantitative easing and also drop interest rate. Actually, we do not know. So for me, as a REIT investor, I just need to pay attention. Interest rate will come down. It may not go back to the previous low. But on another hand, when it comes to REIT investment, why they want to keep an interest rate at such a high rate is because of inflation, right? Eventually, this kind of cost pressure you pass on to the consumer. What does it mean? Which means that the rental goes up. At the present moment, because of the rental reversion is not rising fast enough, because we have a very long lease, right? But the interest rate is in this exponential increase. They are just increased too fast and your rental cannot catch up. That's why you have an immediate compression on the DPO. But over the long term, if you're given a time when the rental reversion, they are able to catch up, right? I think things will back to normal again. Right, but that will take time.
Okay, fair. I get what you're saying because a lot of them, they sign lease that are much longer relative to the movement of the interest rates, right? Which is what's happening.
Right. Okay. And there's no right or wrong on whether you have a long lease term or short lease term. It really depends on in what kind of environment you're in. For example, in the recessionary environment, you want longer lease. In the inflationary environment, you want shorter lease as short as possible so that you immediately can cash out the rental because I think you are also renting space, right?
Yeah.
I can see the industrial building in Singapore itself, it can go up by 15%. No? And also the residential, I heard can be 50%.
It's crazy. It's crazy. What is happening? Yeah. It's true. And my landlord come to me and say, like 2 years ago, times are bad. I will sign 3 years with you at this rate. You know what I mean? Because they also want certainty. And also as tenants, if we are fine with the space, we can keep up with it, we will take it.
Yeah.
Right. And then we ride through the uncertainty at the discount, because they already give us a discount. It's like, okay, this 20-30% is your float, right? Then you see whether you can kind of work around with it, right? And then when things are better, every other month you hear people, my landlord sold the property. My landlord want to increase the price. It's very annoying, all of you, right? Disturbing our life.
But on the other hand, actually, all this kind of tenancy agreement is quite sticky also. You just imagine in the retail space, all right, or in the industrial, if you are renting out a factory itself, they need to incur a lot of capex, do the renovation, right? You don't want every 2 or 3 years you go and move to another places, and after do a renovation again, because renovation can be easily 100,000 and above. So it can be very sticky once you get locked in.
Yeah, unless you're in the mall. The mall's so annoying. So the malls force you to shift around, right? Yeah. It's part of it, right? Yeah. It's like 3 years you must move, change to another lot, right? And then so that they refresh the mall, they force it on the shop owners, right? Yeah. And that's a practice in the market, right?
That's why when you come to reinvesting, if you're really worried about what share price plunged by a lot and you are holding those retail mall in Singapore, you're just going to visit all the retail mall in Singapore. And you have to start to ask yourself, do you think the retail mall can go bankrupt, go bust, and just leave it empty there? We are quite frustrated with not enough car park. Right?
He's speaking about experience, because just now he struggled to find a car park, right?
Yeah, and also there are so many people, and also all the things you buy from retail shop, it's so expensive, all price increase. So actually retail mall doing pretty well in Singapore itself, right? So if the share price drop by 50%, I don't understand why you have to panic and sell all the REIT.
Okay. So and I like it that you start to categorize it, right? Because retail malls is one type of REIT, but in the market there are many other types. So maybe we can kind of go around.
Yeah.
What about like things like office REITs?
Office itself, okay. We don't generalize the US office and Singapore office. They are totally two different breeds, two different directions, right? But when the market have a sell-off, there's no indiscriminate.
Okay,
because nobody go and analyze the detail and everybody panic. So US has its own set of issue, all right? Okay, a little bit politics.
It's okay. You can say I cannot tahan, I will cut.
Yeah.
If you hear this, that means can tahan, right? Yes, go.
Singaporean more obedient. Your boss asks you to go back office, you go back office. Right? Guai, go back office. But US, they don't really go back to office. All right? Human right. So that's why the back to office trend in US is pretty poor. Then that caused the occupancy rate on the commercial office drop. When your occupancy drop, if you are the valuer, do you want to put your formula 100% occupancy?
No.
It looks stupid, right?
Yeah.
Okay, will you put 70%, but at the present moment it's only 50%, you also look stupid, right? So in order for the valuer to protect that right, they'll put very conservative number. When they put very conservative number and they put very high cap rate, plan in the worst case scenario, your portfolio value will drop a lot. Okay, that is why the valuation of a US office plunged a lot, and the share market does not like it because they do not know whether the worst case has been priced in. Everybody shun away from US commercial office. But in Singapore itself, you look at it, you'll be amazing. It's totally different story. I have a chance to talk to OUE Commercial REIT. Okay, and also Keppel REIT just announced.
If they want to sponsor, they can sponsor.
Right. And also Keppel REIT just announced have a business update 2 or 3 days ago. Surprisingly, the occupancy rate in Singapore commercial office increasing. Top line is increasing. Okay, and the average rental rate in the Grade A CBD area is increasing. And it's quite consistent for a Singapore office. And that also can be explained. Occupancy rate is higher because now everybody quite go back to office, right? So that actually gives a very strong preservation or protection in the property valuation. When you have a property valuation very stable, okay, your share price can hold pretty well. Okay. Now, but the DPO payout is affected.
Of course, because interest rates are there. Yeah, that one is never changed.
Yeah, never changed.
Just a valuation change. So the unit price not so affected.
Right. You got it. So I look at it, top line growing, and the macro, the whole commercial office rental growing, occupancy growing. This is the right trend. Okay, now it's an interest rate portion. And eventually, this, if they continue to grow and interest rate fix, eventually you have the gap again. Then the DPU will come back again eventually. And if you continue to have a growth in rent, and when interest rates start to drop, then your DPU will grow. When the DPU will grow, your share price will start to grow again. Okay, but it's not going to happen immediately. We just need to wait for another 2 or 3 more quarters when you have a better visibility on what will be the interest rate movement. I think the share price start to react. Okay, and also share price will start to react 6 to 9 months ahead before the actual announcement, because investor, especially big institution fund manager, they always look forward, and they always have this kind of insight, talking to the REIT manager itself on what is happening in the market before the earnings coming up.
Yeah, we should talk to the REIT manager also, right? We should talk to the REIT manager.
Right. I'm talking to them very frequently.
They must come. Yes. Okay, fair. Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. Okay, I get the commercial thing. Yeah, then if we move further down into like industrial REIT,
Industrial, in general, not all industrial REIT is good.
It's very complex actually. Inside got a lot of different chapalang all put as industrial.
Right. You put it in industrial, but under industrial, you have a business park, you have a logistic warehouse, very complex. Okay. In general, industrial sector actually provide the most resilient and most stable dividend. Right. So if you want to build a very strong core portfolio, you make sure your dividend don't yo-yo. You use industrial as a core portfolio. Okay. But stay with those industrial, which is very diversified, and stay with those big cap. And also just pay attention to those industrial REIT, which has very small market cap, and they are overly concentrated in Singapore sector, surprisingly. Different ballgame. Just now I talk about commercial office Singapore, right? Industrial, pay attention to a Singapore property. The reason being is because of industrial building in Singapore, they have a shorter lease, right? When your lease getting shorter and shorter, your valuation will drop. When the valuation will drop, your share price will drop. So now this is a struggle for the REIT manager. How can they continue to keep the NAV stable or increasing? That is a reason why some of the REIT manager out there, they are selling the Singapore industrial building, they go overseas.
Yeah, you're seeing more and more of that.
Right. That is a reason. That is a reason. Because overseas logistic, factory, industrial, some of them freehold. When you have freehold, you know that valuation, no matter how, will not drop. You increase over time, but Singapore continue to drop. So one is on the declining trend, one is holding well, increasing. That's why they have to go overseas. They got no choice.
Okay. But on the industrial side, right, actually over the past few years, there's been a lot of upgrading things going, right? It's not as exciting for like retail or like office. It's expected to upgrade. Right, but like in the industrial REIT space, right, you hear a lot of REIT manager coming out and say, "Oh, we're gonna rebuild this thing, we're gonna upgrade, we're gonna like change these warehouse into like tech park." You know, like a lot of this thing. You know, like what is happening now at this point in time? Yeah,
it's still back to a DPO and also the valuation. If you do nothing, your aging property value will drop. Your maintenance cost will increase. When all this increase, your tenant will not want to pay for this kind of rental. They'll look for somewhere.
Next door got a new tech park. Right, let's go.
right. That's why in order to really keep the valuation, keep a tenant, they have to continue to keep their building in a tip-top condition so that you can get higher rental, fetch higher rental, at the same time protect your valuation. They have to do that, no choice.
Yeah. But how has that come along? How are they performing with that? Because that is the dream, right? They keep selling the dream for a few years already, right? We'll upgrade our industrial properties, but how has that performed?
One or two of the smaller cap, they actually perform quite well. I can see that based on past data, the NAV keep coming down. Then at least they start to reversing, right? That reverse is a good sign. Okay, but they have to continue to do it. But on the other hand, if you want to continue to do it, you need money.
Yeah, it's expensive.
Right. At the present moment, they cannot do it for all the property. They have to do one thing at a time because they don't have money. Especially during this period, you also cannot raise funds. So there's a limitation. So so-called portfolio rebalancing is continuous activity for the REIT manager. Got no choice.
Okay.
They also have a limitation, hand type.
Yeah. Very interesting for the industrial front. What about a more specific like medical data center? Those very small REIT, very specific. Yeah.
Their
valuation always very high one there.
You talk about that one.
Yeah. Both of them very high ones. So.
Actually, no.
Yeah.
Too extreme.
Oh, okay.
Too extreme.
Come on.
One of them is a premium medical because they own the Gleneagles Hospital, Mount E, atas one.
Atas
when
one.
the atas one also for premium also high right?
Yeah.
But the yield is around 4%, 3.something%, 4%.
Yeah.
Okay, but still holding pretty well.
I don't know why. Can you educate us? Why? I was like, because the yield not very high.
Yeah.
And it's not even like they sell the story of like medical growth, but the yield, the REIT don't have the upside. Right? Like it's not the business itself has the upside as more and more medical, blah, blah, blah. But the REIT没有leh, right? It's a property business.
I think it's the business because they have the private hospital, Atas brand, and they also have a Japan nursing home. And at the same time,
very specific.
Actually, so if you look at all the financial ratio, they're the top. Yeah. All right. If you look at interest cost, less than 1%. I think if I can remember, less than 1%, they are borrowing Japanese yen. The Japanese yen interest cost very low, right? So they are able to maintain the kind of spread. At the same time, their cash flow is very strong, okay? And also their strategy is very clear. So actually, that rate is a benchmark for other healthcare REIT in that sector. They use that one as a benchmark. And if you look at the yield spread, it doesn't really make sense. US Treasury bill at the present moment is 4.8%. The REIT only give you 3.something%. Then that one is risk-free, one is not risk-free. It doesn't really make sense.
Yeah.
So the only explanation is there are a lot of strong believer and strong supporter and continue to park the money there, all right, and wait for recovery. Because when the market recover, this one will fly. But you need to wait for the interest rate to come down first, right? Then the money will flow back to this healthcare REIT. By the way, this healthcare REIT has already retraced a lot. But they're still holding pretty well.
Okay, fair. What about data
the
center?
Other extreme
the other one.
The extreme one destroyed by the old sponsor. So the investor totally lost confidence, right? They have come out the growth 2.0 strategy. It's so clear, obvious already, right? And I like the strategy.
So growth 2.0 means just already. It means like
no, not just
Okay.
I believe their strategy.
Okay.
Because I follow this REIT for very, very long and also have a chance to talk to the CEO itself. Okay, I understand what they are 100% doing. Because previously they have 100%, close to 100% hospital in Indonesia. Okay, and they collect rental in Indonesia rupiah and pay Singaporean investor in Sing dollar. Should I?
Die.
Right.
Sing dollar strengthened for the past few years.
So because of that issue, they are not able to. It's not able to keep out a dividend. That's why you can see all the dividend keep dropping now, right? Because of that issue, they have a massive equity fundraising, right? Then dilute the share price a lot, really a lot. And they also have a change of sponsor. Okay, since then they come on a Grow 2.0 strategy that diversify into developed market. Because Indonesia is still an emerging market, right? The risk level is much higher. Now they are venture into Japan. They want to increase the Japan nursing home, right? At the end of the day, maybe they're looking at Australia. They just said developed market lah. I would say that developed market, you'll be Japan, Australia, maybe Singapore, right? And they want to increase the ratio. They are using the first, just now the premium healthcare as a benchmark.
Okay.
Okay. And the price book valuation, I just let you know, if you believe in the story, you can see the upside. If you don't believe the story, then forget about it. Right? The price to book for the premium one is 1.6, which means like 60%.
60% above the value of the property itself. Yeah.
For the other extreme one, I think the price to book around 0.5. I cannot remember a number. It's very low. It's very low. If they are able to execute this growth 2.0 and get the confidence back, you just look at the gap, the capital appreciation. So if you want to take a risk, you look at the return versus risk, and you can see the opportunity. Because at the present moment, if you look at share price, it's at the bottom and moving sideways for quite some time already. And the dividend yield is not bad also.
Okay, fair. Reverse to mean. That's the base idea, right? If it doesn't reverse, then lame, right? But what about Okay, maybe last one. What about the data centers?
This year, actually, data center is the best performer. There are 2 data center REIT. Okay, and it's cyclical. Last year, you heard a lot of negative news on the data center. Whether it's news manipulation or not news manipulation, up to you. I can see a lot of news. Okay,
yeah.
To me, does not make sense. Okay, I think the news is being created so that you have a huge sell down to cause all the investor panic, sell.
Never not house view, never a big conspiracy. A big conspiracy.
And this year, actually, the data center is the best performer. I can see that actually they start the uptrend. Okay, but recently, due to the spike in the 10-year treasury bill, the risk-free rate has just started to drop again. Okay, but data center is still the best performer. My view, moving forward, the whole world is going through the digitalization, right? We also have a lot of technology disruption, AI, and 5G rollout. You can see that all these things need data, right? You need a data center to hold the data. You need a data center to hold processing. And I don't understand why people say that there's an end of data center. I don't understand. It does not really make sense.
I think some of the tech guys are trying to build a different type of data centers.
Yeah.
Or different new ways of managing and storing the data, right? So,
but my will is the big guy can do that. Because the tech sector, a lot of new guy coming up. They also don't have cash to build.
It's fair. It's very expensive. It is a very expensive business.
And we just need to model the EMS, electronic manufacturing services. All right.
Last time you were, yes.
Last time Motorola, Hewlett-Packard, Seagate, they build their own factory, right? Everything do by themselves. Then after that, they think that they're not cost competitive enough. They need to outsource it. That's why there's a growth of EMS, electronic manufacturing service, because they have an economic scale, they have all the equipment, right? They can really leverage whatever equipment to optimize the return on asset. So data center, I personally feel that you'll be moving towards the same direction, because at the end of the day, tech company, most of the tech company, they are more data driven, they are more IP, they are more software. That is the core skill.
That's a big business. That's the 赚钱 part.
That's 赚钱. Brain cell.
Yes.
Data center is a hardware.
Yes.
Right?
Yes.
Then if you want to have another set of team doing something you are not specialized in, not your core business, it really does not make sense.
It's very hard. No point.
Right.
Yeah,
That's why eventually, I think that data center, majority of them, they'll be outsourced. Right, they'll be doing themselves. Let the expert do their own thing. Then all those core business they'll retain in house, because some of them you can outsource, some of them you can outsource.
Okay, fair. And for all you, fun fact that you didn't know, Singapore is a very important node in this global data transfer process. Right, we got the Singapore Internet Exchange, and the wires all connect here. Right, so yeah. And internet goes by wires, if you didn't know, okay? So for some reason, it's deep sea internet cable, okay? That's a different discussion. Yeah, fair. I like it. Like we went one round all this, right? So maybe one of my last few questions would be like, you see more and more of these kind of like local Singapore REIT, right? They are listed in the local markets, and they started out with like mostly a Singapore portfolio, but more and more of them are going out. And I think you paint a little bit of the picture already. Here, Sengli not so good we got to go out right? We got to make some money elsewhere. But then when they start to go out, right? Even one of the earlier example about Indonesia, right? They are all exposed to a lot of these kind of currency problems, right? Like, so how will you kind of evaluate this thing? Yeah.
When the REIT start to expand overseas, immediately they'll increase the risk in their portfolio. There are a few risks. One of them immediately is a currency risk, right? It depends on how they hedge it. For example, if they are buying the property in US, they'll be buying in US dollar. If they borrow the money in Sing dollar, that is also a risk. If they borrow money in US dollar, it's not a risk, and pay out dividend is not a risk because it's all auto hedge, right? Then the risk will be on investor side. Okay, so I summarize again. If the REIT have overseas, for example, US property, collect rental in US, the debt in US, dividend in US, traded in US, the risk is not at the REIT manager side, it's the investor side. Okay, some of the REIT they have they pay in Sing dollar, but collect rental in US, debt in Sing dollar, then they have to manage it, right? Then it tests the skill of the CFO. If the CFO, one of the listed company in Singapore, they hedge wrongly on the oil price and lose a lot of money.
Oh my.
That kind of mistake can happen, right? That is more on the oil side. You don't mention name,
It's okay. We get it. Yeah. You don't get it also okay. We're not going to say. When you meet us in person, maybe you do a live event. Right. Maybe we can tell you off screen. Yes.
So there are a lot of danger in the investment world. You have to know all these things. If you don't know all these things, those are the risks, right? So that will be a risk. Some are REIT, they have a multiple portfolio, and one of logistic REIT itself, I look at the debt profile, I look at the currency, I faint. We have Korean won, you have Japanese yen, you have Chinese RMB, you have Malaysian ringgit, you have USD, you have Euro. They still can manage quite well.
CFO.com, right? The CFO solid. Shout out to you.
That's why the skill of the management team and also experienced management team is very, very important. Now, whenever there's a new IPO, I don't even know them. I will look at their management profile first. Where are they from? Right? If the management come from nowhere, not the big guy and no experience, you better be careful.
Okay. So that is the bigger concern, right? When you're looking at that.
Forex REIT and how you manage a debt. Okay. And also when it comes to China itself, China, because of capital control, whatever rental you collect in China, how the REIT manager can bring it out. That is another big question mark. Okay. So I cannot say in public, there are a lot of tools and skill set, how to maneuver this kind of thing.
Tools and skills. Okay. Fair.
I only know when I speak to some of the REIT manager.
Okay. So China is an extra concern there.
Yeah, just have to pay attention that how they get money out, because eventually our DPO payout is from the rental income. Okay, if there's a capital control, your rental income cannot come out. That is another issue. But normally when the REIT get listed, they know how to maneuver it. So that's why when one of the US commercial REIT first listed, nobody know how to structure the whole deal itself for a tax purpose. Then after that, there is a case study. There's a model. Everybody just model.
Okay. Fair. Interesting. Oh my God. I think it's a lot of interesting insights. Any last things you want to add for our audience, especially a lot of people that either still on the fence looking at REITs, and some people are like opportunity hunters right now. It's like, cheap, can go, right? So some people are like that. And then there's of course the other group that you were saying that is like, oh, I lost a lot of money, I want to go, right? So like, is there any last things you want to add for?
When it comes to REIT investing, actually the investor must be very clear what are they investing in. For me,
I think all investing not just REIT
Yeah,
right? All time you better be very clear what
you must be very, very clear. What are you investing in, and what are the characteristics of this investment, this asset class, and how they generate the income. That's very important, because REIT at the end of the day, they are relying on the physical real estate to generate income. Okay, so no matter how bad a business, the physical real estate is there. This is unlike the dividend stock. Dividend stock depends on the business model, depends on the economic mode to generate the cash flow from the operation. It's the operating cash flow. If the whole so-called economic mode being destroyed, or their competitive advantage being destroyed, you definitely have the lesser operating cash flow. When the operation cash flow getting lesser and lesser, you definitely hit a dividend, and they can go bust, zero. You cannot get back anything. But REIT eventually, as long as there's a building, as long as they are still human living, all right? If we don't being nuclear bomb, then the property then disappear. Very different. They're still there. You just imagine for those retail mall, thanks to the MRT, do you think they'll disappear one day? if the operator not able to really manage it, eventually someone will take over and buy over, right? You still can get better value. So it's very, very different. Once you really understand the business model, when you see the current valuation in the market, just for reference, at the present moment, the price to book for the whole Singapore sector is 0.7, around that area. During the March 2020 COVID crash, the valuation is 0.8. At the present moment, it's even lower than during COVID crash. And when the whole thing being frozen, or we cannot go out, lockdown, worse than that, right? And the current issue is purely more on the interest rate. I would say that it's a noise, it's cyclical. And before COVID, the price to book is 1.1. 1.1, 0.8, March 2020 COVID crash. At the present moment, we are close to March 2020 is 0.7. So then investor need to think whether it makes sense or not. And if you really follow your common sense when it comes to real estate investing, you should be able to see a lot of opportunity. But also need to take note that only pick the fundamental good REIT, because some of the weak REIT, which balance sheet not so strong one, actually they are being destroyed already.
Of course.
That's why you can see there are few REIT in Singapore. So far I know 2 REIT in Singapore never pay dividend.
Ding, ding, ding. This is
got problem already.
Very problematic.
2 REIT can consider suspended. And Money FM lah.
I know.
Yeah. So I mentioned these 2 REIT basically very likely they go out of business because their tenant is their sponsor.
Okay.
So the sponsor not able to pay you rent. It's something like your father don't give you pocket money. Can you go and sue your father for not giving you money? And they have a debt sitting down there to be refinanced. I don't know how they're going to get it out. Right? It's a sponsor. All right. If a sponsor can recover, they can recover. But sponsor is also in the property development. You know that property development in China is really bad now. So 2 REIT most likely to be kaput. My personal view. All right. Okay, based on the business model. So REIT selection is very important. You don't choose the wrong one, choose the wrong one. Basically, okay, there's no turning back. Okay, no matter how cheap it's there, you don't go and buy the rotten apple.
Okay? Thank you. Lovely. Love it. Okay, where can they find you if they want to follow you?
Wow.
Yeah.
Google.
Just Kenny Reid. Confirm you find only one guy, right?
Yeah.
That's that.
Yeah. You can find me through the Money FM, LinkedIn. You can find me easily.
Yeah. It's true. Thank you for your time. Lovely. Thanks.
All right. Thank you. Bye-bye.